Good morning, everyone. Welcome to our seminar today on selling a business, focusing specifically on asset sales versus share sales and what your business needs to know. It's very good to have you here. So we'll be covering a lot today. For the first part, I'll be speaking for about 25 to 30 minutes, covering some of the fundamentals like when to know when to sell and establishing a purchase price. And then we'll go from here. But of course, this seminar is also very much relevant to the buy side, not just sell side. So my name is Morgan Sheargold, and for those of you I haven't met before, I know there's a few familiar faces here. I'm practice leader of the corporate transactions team here at LegalVision. I do everything from capital raising, so seed to series stage, all the way through to end stage mergers and acquisitions, with a particular focus on sell side founder M&A. Been doing this for about 10 years now, which feels weird to say. And my deal range is sitting between around 800,000 all the way through to 2 billion. So I've seen a lot of weird and wonderful things, and I will share some of those tips and tricks with you today. So just before we begin, a couple of small housekeeping points. You will be receiving the recording and slides in your email. Please submit your questions in the Q&A box, and I will try and get through as many of those as possible at the end, with special thanks to those who've done pre-submitted questions. And please complete the feedback survey after the webinar. I'm also very keen to hear ideas for another webinar, whether you'd like me to drill down or provide more granular detail on a particular aspect. So I look forward to receiving that. And also one final housekeeping point, by viewing this webinar, you are eligible to receive a complimentary consultation with us to discuss your business needs. Please leave them in the survey that appears at the end, or feel free to contact me or a member of the team via our website. So a quick poll question before we get started, and I'll come to the answer in about 2 or 3 minutes. But which aspect of selling your business do you find most challenging? Choosing between an asset or share sale, understanding the legal risks of each option, assessing how the deal affects business value, avoiding common sale process traps, preparing for a smooth transition, or all of the above. Not sure, here to learn, which is also completely fine. So today we'll be discussing the preparing for sale stage, structuring the transaction, negotiating and documenting the deal, managing the completion process, and then the Q&A at the end, as I mentioned earlier. So first things first, choosing the right time to sell. So when you're planning to sell your business, you need to think about whether or not it is the right time to sell. And this is really the first fundamental question. So factors that can influence this are market conditions and trends for your industry, the economy as a whole, and the overall financial performance of your business for the past 2 to 3 years and its financial projections. Now, obviously, it's not always the case that you want to sell when projections are really, really strong. That is, of course, an ideal scenario. But as most of you would know, as business owners or in the space, of course, things don't always unfold that way. I should mention, of course, that it's absolutely still possible to get a great deal, even when the market conditions are uncertain or projections have fallen short. What you need to think about, particularly in those circumstances, is your strategic positioning relative to competitors, and of course, what the long-term value of your business is. So in COVID specifically, I did about 10 to 20 distressed M&A sales, obviously very bespoke, unusual circumstances, and buyers and sellers alike were able to get really, really good value deals as the documentation was just catered accordingly for them. So establishing a realistic asking price. Also, all of the above, not sure, here to learn. We've got 72%, which is great to see. This is, of course, poll results. We are here to learn, completely fine. So thank you so much for completing that survey. So number 2 in the fundamentals is establishing a realistic asking price. So once you've decided it's the right time to sell, you need to figure out a realistic asking price. And the question I see a lot with sellers is, where do I even start? How do I get to that number? So the price you can get for the business will obviously depend on the financial performance I just discussed. So whether it's moving, growing, declining, or just maintaining at a steady pace. So first and foremost, I always recommend getting an accountant or a commercial advisor involved at this really early stage to assist developing the valuation of the business. Now, While that's a great first step, it is still important to remember that the valuation of the business, wherever that lands, is not actually commensurate with what the purchase price of the business should be, which is again a common pitfall I see with a lot of sellers who, for instance, might get a valuation of 5 million and propose that as the purchase price, and then wonder why they're getting a little bit of pushback or questioning from the buy side. Now, the actual purchase price is determined slightly differently to the valuation. Of course, the valuation still guides what that looks like, but I did want to touch on the two common methodologies. So the first one is the EBITDA multiple, which of course is the earnings before interest, tax depreciation, and amortization. Now, this method of determining the purchase price effectively multiplies the business's EBITDA by an industry-specific multiple. So, for example, tech industries, we typically see the multiple sitting at 6 times to 10 times, whereas in residential or retail or manufacturing businesses, the multiple typically sits more at around 3 to 5 times. The main rule of thumb is the higher the multiple applied, the higher the buyer views the growth potential of the business. Now, if you're calculating an EBITDA multiple yourself and arriving at a purchase price, I would typically recommend people look at the industry norms. There is a lot of information on Google, but of course, your accountant or commercial advisor or lawyer will also be able to tell you what that typically looks like. Now, the second methodology of calculating the purchase price is the revenue multiple. So again, this method multiplies the business's annual revenue, which of course is more the top line figure, as opposed to the EBITDA, which is more so a profitability measure. And again, this is more so used in high growth sectors like tech and IP. So for instances, with the revenue multiple, for tech businesses, it typically sits at 2% to 6% revenue, with retail and manufacturing again sitting at 1 to 3% revenue. Now, those are the two common ways of establishing the purchase price. But of course, even where you establish that yourself, which is completely fine based on an industry norm or specific, there is still likely to be a negotiation from the buyer. Now, that can range from the actual figure that you've arrived at, let's say the 5 million, and particularly that does happen where it's an institutional buyer or what we call a trade buyer that actually has familiarity and knowledge with the industry. And it can also go back to how you've calculated your revenue, your EBITDA. And so in this sense, I always recommend that you have the financials to back up however you calculated the purchase price. That is very important. But of course, again, accountants, commercial advisors, and lawyers will be able to help you with any kind of negotiations on the purchase price. Now, the third fundamental part of deciding when to sell is identifying potential buyers. So again, we see a lot of clients who are really motivated, ready and willing to sell, but they don't know how to identify a buyer. So again, there's two common ways to do this. So the first is to engage, again, the commercial advisor and the business broker, and then you can tap into their network of industry connections. One thing I always strongly recommend with engaging a commercial advisor or a business broker is do engage someone who has particular or specific expertise in your industry. For instance, engineering, it won't be useful to have a business broker necessarily that works specifically in, let's say, the retail industry. So that is one thing just to be aware of. Now, secondly, you may also just have industry contacts and know people and have interest from the market just outside any kind of brokerage service or commercial advisory service. In that case, I've seen a lot of clients establish their own information memorandum with the proposed purchase price, circulate it out to the market, and then get bites that way. So that's another way of doing it. Of course, here at LegalVision, we have a lot of partners that do that for you. We know a lot of brokerage services, a lot of advisory services, and we ourselves are quite tapped into what the market is looking for. So of course, we're able to help if you're really struggling to identify anyone to buy the business. Now, next thing is preparing the business for sale once you've gone through those three fundamental steps. So once you've figured out the suitable asking price, it is time to start getting the business in order. Now, the first thing to do, which again, is a really common pitfall that sellers do not do, is do an audit of the documentation of your business to understand where there are gaps that might need to be addressed. Now, all too often I have, clients, of course, that say, we're ready to start DD, but we've realized we don't have, a constitution in place, or our members register isn't correct, or it's not compliant with the Corporations Act. What do we do? And the answer is really we need to rectify as much of that as possible before we launch into the formal DD phase, which again is something we can do. Of course, businesses' housekeeping will never be perfect, and that is just the way it is. But this DD cleanup phase is really essential to minimize those gaps. For those of you who actually came to the Scale Up Strategy session, one thing I said is that I find very successful businesses, either in the startup or scale up phase, often approach everything, even from the beginning, with the end exit in mind, whether that's IPO, M&A like we're talking about, because they tend to apply the same rigor to the documentation process and housekeeping that's commensurate with an IPO or a trade sale, which is great. So in terms of some key pitfalls, we often see circumstances here where there's handshake agreements only in place between suppliers, customers, employees, and that will just be really difficult for a buyer to extract any value from. It's very hard to say I'm asking $5 million, but none of my contracts are in written form. And so, of course, if that is something you identify that you're missing, we can document all of those arrangements prior to the sale and prior to the DD process. So as part of the cleanup phase, it's also really important to start thinking about the key components of your business and the value proposition. So if you're in a tech IP focused industry or business, you should be thinking about, for instance, do I have registered trademarks? Am I concerned with the third-party use of intellectual property? And do I have the documentation in place to support and manage those risks? And if the answer is yes, that's of course great. If the answer is no, again, we need to be doing some gap filling there. So similarly, if you operate from a physical premises, do you have a lease in place? Is it a good lease? Do you have a sufficient term remaining? If not, again, we need to do a rectification process. So these are all of the kinds of questions that I really encourage buyers and sellers alike to think about as part of the DD cleanup process. Now, the DD process itself, so again, it can be a lengthy process, it can be time consuming, and I always warn clients about this at the start because often you launch into DD not realizing the scope or what it will necessarily entail. So the first step is to enter into a non-disclosure agreement or a confidentiality agreement, and effectively that protects both parties' interests during the DD process. So for instance, it means that as a seller, the buyer's agreeing they can't use your business confidential information provided as part of the process for any other means outside of considering whether to enter into the transaction. But on the flip side, you as the seller might get some comfort from the buyer around exclusivity. So for example, they're not talking to anyone else other than you about a proposed acquisition. Similarly, DD can take place certainly after an NDA, but before or after a term sheet or a heads of agreement. Whether or not that is the case, there will just always be a process by which the buyer will want to investigate the business to understand if it's worth the asking price. I should note as well that the level of rigor and the level of involvement around DD is typically governed by the types of sale that you're going with. So we call it M&A, of course, but that really is an umbrella term. And typically it's split into three components. So the first style of M&A is a trade sale. And as I mentioned earlier, a trade sale is often a sale to another company, an institutional buyer within the same industry or sector. So they have some familiarity and knowledge about the business. Now, a trade sale typically results in a higher sale price simply because the buyer will be looking at market expansion and they're attaching a premium to that. The next type of sale is a unilateral sale. So it's sold to a single buyer, often a company, investor, individual, whatever it may be. Now, unilateral sales tend to be faster, more straightforward. Everyone has a common goal, but it does often result in a lower sale price as there's not as much competition or negotiation. And then finally, we have a competitive sale, just my personal favorite. This is when a company effectively tenders to multiple buyers to see first in, best dressed, who do I want? And then they get to select their own buyer. Now, this definitely drives up the sale price and improves terms for the seller. And of course, it is typically faster as there's a lot of urgency that we see between competing buyers. Now, back to DD, in order to start the process, the buyer will first send you an LDDQ or a legal due diligence questionnaire that will set out all of the questions they'd like to know about the business, ranging from have you had any employee disputes in the last 6 years to show us all of your constituent documentations, constitution, records, shareholders agreements, etc. You'll then have an established forum through which to provide that documentation. So that can range from the more formal things like answer writer and Intralinks data rooms, all the way through to something with a bit more simpler functionality like a Dropbox or a Google Drive. Now, they will then review all of the information you've provided and come back with further RFIs, or what we call requests for information, that you will work through again over time. Now, typically in a normal sale, I should say that I typically see 2 to 3 rounds of follow-up RFIs. I have seen up to 15, which isn't ideal. It was very stressful for the seller and buyer alike, of course. But in that specific situation, they hadn't gone through the rectification process or the cleanup process that we discussed earlier. So you'll then submit all of your responses to the questions. Once that is done, the buyer and their respective advisory team will establish a DD report. The buyer will review their own DD report and then make an informed decision about the information provided and effectively make an assessment about whether your business is worth the purchase price that you're asking for. Now, if they find particular gaps, which we'll come to in a moment, they may ask for warranties or more indemnities under the terms of the agreement. So something I should also say in terms of timing is DD doesn't have to occur before the sale agreement is negotiated. It can happen in parallel, just because whether it's a business asset sale or a share sale, the agreement is usually predicated on DD being undertaken to the reasonable satisfaction of the buyer. So if that condition is met, the buyer's not on the hook, but if it is, it just means you've been able to negotiate everything in parallel. So structuring the transaction, now this is the big one, and I do want to say at the outfront, it's extremely important that you get the right legal, financial, and tax advice earlier rather than later, I would say. And tax in particular is a really, really big one. I've seen a lot of transactions that are very close to signing or completion, and tax advice hasn't yet been obtained. And what we don't want to see is you're about to sign an agreement, and the way under which it's been structured actually creates a significant, let's say, CGT issue for you. And then we have to unwind the transaction. And of course, that's just time and money that isn't necessarily well spent. So we have fantastic tax colleagues here. They work with me all the time on the M&A transactions, and they're really, really well placed to help you at the very outset. So please also message me if you'd like a tax consult. That is completely fine. So on to the asset sale versus share sales. These terms, in my experience, are used interchangeably, but they are extremely different beasts, very, very different beasts. So there are two fundamental ways to structure a deal. You sell the shares in your company, or you sell certain assets that your company or your business holds. Now let's do the share sale first. So in this type of transaction, the buyer will acquire a percentage of the shares of your business. So often this is 100%, which is a complete acquisition or total buyout, but sometimes it's a partial acquisition, like let's say 55% because they want to come in as your partner. Now, what this means is that the company is staying the same. So there's no change to the company name. It doesn't change in any way other than the ultimate ownership shareholding of the company changes. Now, what that also means is all of the contracts are still staying with the company. So that's clients, suppliers, employees. There's no new entity. They're not moving anywhere. As I said, it's just the ultimate shareholding that's changed. Now, this structure can have quite a lot of tax advantages over an asset sale. But again, of course, we recommend that you seek specific advice at the relevant time so we can cater and structure a transaction specific for your needs. Now, share sales tend to be quote unquote cleaner in that sense, but there are some cons or disadvantages. So if the buyer is acquiring 100% of the share capital of your company, what that ultimately means is while they're getting all of the good stuff, they're also acquiring all of the bad stuff. So this means all of your historical, contingent, actual liabilities and risks. And what that also means is that a buyer, because they're inheriting those risks, will manage that as much as they can via the terms of a sale agreement. And as opposed to an asset sale where you're cherry picking or a buyer is cherry picking and plucking out certain assets, in this case, the sale agreement will have a lot of extensive warranties around the historical conduct of the business. So as the seller, you might be required to warrant that there's never been a tax issue, there's never been an employment issue. Of course, you can carve out specific things if you know there has been, that's completely fine. But in the share sale, because of this, the warranty regime is typically a lot more heavily negotiated. Now, again, there's also something we call indemnities that are typically sought more often in a share sale versus an asset sale. And this effectively, an indemnity is a contractual promise from you to pay back the buyer or to refund a certain portion of the purchase price if a risk comes to fruition. So by way of example, there may have been an employee dispute 3 years earlier, let's say, prior to completion of the sale. The company didn't take care of it, and then the sale happens, and 2 years post the sale, the employee comes back and says, sorry, new owner, I'm actually owed $200,000. Now, we call this the allocation of risk. What risk should sit with you before the sale and what risk should sit after? And in that case, you would more than likely be on the hook to either pay $200,000 of that amount or a certain other agreed proportion back to the seller. Now, the best way to mitigate against this is the DD cleanup and also disclosing as much as you can in DD because we can carve out all of those risks. And in that case, it might be like, other than the dispute that happened 3 years ago, I don't know about any other risks, which is completely fine. Now, if there's particularly material risk, you might be asked to provide a personal guarantee or a security if there is a breach of warranty. Now, something again that I see a lot is sellers saying, I'm really worried about warranting certain things in the business because I just don't know if that happened or if it didn't. And of course, that's completely fair. You can't always have eyes in the back of your head and be all-knowing. But what I will say is warranties given under the terms of a share sale agreement will be qualified by actual knowledge. And what that means is you cannot be on the hook or liable for risks unless you actually knew about it. So that means you had knowledge of it and you deliberately didn't disclose it. What it doesn't mean, or it doesn't imply a level of constructive knowledge, which is you should have known about it had you made the requisite inquiries. Now, the knowledge qualifier, as we call it, is always a big, big negotiation point, but we always push for the actual knowledge qualifier, which gives you a lot more comfort around the warranties that you are providing. So next, moving on to the asset sale. So this is a very different beast, as I said. So this is effectively, there's no change to the ultimate ownership of the company, but you're plucking out certain assets. Now, for example, if the buyers decided they wish to acquire your equipment and your contracts, you'll likely be required only to provide warranties in respect of the equipment and the contracts. So you won't be required to warrant, the historical tax position of the company because they're not inheriting that risk. And as part of that, of course, you can agree to exclude everything else. So you exclude cash, lease, cars, everything else, which makes it a lot cleaner understanding which assets are going across. Now, on the other hand, the transfer will likely require the consent of third parties, which is a little bit painful sometimes. It can be more onerous. And this is because they're being transferred to a completely new entity versus a share sale, as I mentioned, where it's just companies staying the same, just the ultimate ownership is changing. So again, in the asset sale, the liabilities will remain with you, most likely. And that's because they won't be electing to take on liabilities as part of the sale. It's just extremely uncommon. Now, the difficulty with that is it means that certain assets might be plucked out of the business, you remain with the liabilities, and then you have to go through, if it is of course your preference, a wind up of the company, which takes time and money. So as you can see, these are quite different structures, but of course I should say there's a lot of creativity involved in this. There's a significant amount of hybrid structures that we can do. It's not always black and white, but we can effectively always structure something such that it's in your best interest. And to that end, that is why I always get tax, financial, and legal advice. So next, once you've decided how to structure it, there are various ways that the purchase price can be paid. So firstly, upfront. So upfront simply means that the purchase price or a portion of the total purchase price, let's say $5 million, is paid to you on completion or settlement of the transaction. That's the most common, it's the most simple, and that's just what it is. However, we also receive deferred payments. So if a purchase price is to be paid as a deferred payment, this means that a portion of the total purchase price will be payable on a set date after the completion date. And a buyer may want to defer payments either because they're waiting for a milestone to be met, they're waiting for you to get those, handshake agreements into written form. It really is a corollary and a result of what they've deemed to be a risk as part of the DD process. Now, next, another way to structure part of the purchase price is to use an earn-out mechanism. Now, this is probably less common in a total buyout, but more common in partial or tranched sell downs, or where you're providing additional services as part of the transitional phase or consulting services. So this generally refers to a pricing structure where a portion of the purchase price is earned by the seller based on the performance of the business after the acquisition. It's very, very common for buyers to push for earnouts. It is in their best interest as they're not completely out of pocket on completion. But of course, any suggestion of an earnout should be really, really carefully managed on the sell side, as you want to make sure you can actually meet the conditions commensurate with that final earnout payment. Now, next, sometimes vendor finance is used. It is a bit less common, but we certainly see it. So this happens when the seller also funds part of the purchase price. So in this circumstance, the buyer would usually pay a portion of the purchase price upfront on completion, as we discussed, and then meet the balance, including interest of the purchase price over an agreed period of time with regular repayments to you as the seller, much like paying back a loan. Now, deposits. I also get asked a lot if deposits are common. They are not so much in a share sale, but of course they are more common in an asset sale. It really just depends on the nature of the transaction. Now, negotiating and documenting. So the first thing I always strongly encourage is please understand the motivations, concerns from the buyer. So if they're particularly concerned and you know about the employees, that is likely to come through in the documentation, and that is a risk that will need to be managed there. But of course, if we follow the earlier recommendations around the DD cleanup process, it's less likely to be an issue. Now, preparing for negotiations or negs and handling objections. So the first thing to be wary of is if the buyer of your business is a larger enterprise or an ASX listed business, you will inevitably have less ability to negotiate certain terms. There's often precedent forms that they utilize, and there's often limited movement beyond that. So it's really important to understand the buy side business. Now, again, timing is a factor. If you're desperate to sell because you're moving on or you want to go to Brazil on the yacht, which is actually a current client of mine, that may actually impact your negotiation tactic. You might just want to look at material issues only and nothing beyond that, which is completely fine. But on the other hand, if you have more time, you may want to go through everything with more of a fine toothpick comb and achieve the most favorable terms. Now, the final point of negotiation, which I always recommend, is understanding what market standard means and how it relates to your risk appetite. So effectively, market standard is a term we throw around a lot, and it means what's normal for your industry. And your lawyer, any good lawyer, should really know what market standard means. So in a tech business, for example, the market standard will be the higher EBITDA multiple, as we discussed, and more extensive warranties around tech and systems and IP used in the business. Now, knowing what's market standard will help you ensure you're not leaving any value on the table or agreeing to terms that don't align with what's typical in your industry. So please be across market standards. We are, of course, across all market standards and all transactions and can help you understand exactly what those are. Now, I'll go through some of the key transaction documents briefly, just because they're quite bespoke. They certainly change on a case-by-case basis, but as mentioned earlier, an NDA is typically entered into to give certainty around confidential information prior to DD. Now, the second document is a heads of agreement or a term sheet. Now, as to whether you want to proceed with that, it's not compulsory, but it can be really useful to get an alignment on key commercial terms, particularly if it's perhaps a more hostile sale, before you effectively spend time and money negotiating a sale agreement to then realize there's actually some material gaps in the commercial alignment. Next, the sale agreement or the business sale agreement. Now, this will generally either be the BSA or the SSA, as I just said. There's a lot of hybrid structures, but a lawyer with experience in transactions will be able to prepare a suitable document for whatever the transaction is. So it will include key clauses such as conditions precedent or CPs, completion obligations, warranties, indemnities, if any, we hope not, of course, and post-completion obligations. Now, the final thing before we move to some of the questions is around completion. So completion is just a fancy way of saying settlement, and it's the exact same thing. And completion means the day on which the formal transfer of ownership, whether it's of the shares or whether it's the assets, take place. Now, usually you will have a target completion date in mind. Let's say, for instance, the 1st of July, and that will be mandated by the document. And if that's not achieved, there will be a certain period of time, let's say 30 days, in which you're able to achieve it. It just means, oh, whoops, we missed the target one, but we'll still complete. But often at the end of that 30 days or a sunset period, the agreement will automatically terminate because these can't go on forever. Now, there will be a number of conditions precedent to completion of the sale. And this might be, again, the buyer completing DD to their reasonable satisfaction, the buyer obtaining finance if they're financing the purchase price, or you releasing any security interest you might have over your shareholding so they can be transferred in clean. What I would say is, as part of completion, getting delays is completely normal, but be prepared for it. Don't book a holiday the same day as the target completion date and then be out of action. Give a little bit of breathing room because it just is one of those things. Now, finally, on the lead up to completion, the lawyers will be completely across the completion checklist. They'll go through and confirm everything's done and good to go. If you're worried about not being able to achieve a condition, please flag it early. And then prior to the day of completion, it should be all relatively sorted. You don't want a bunch of documentation still done on the completion day. This should be the clean day where effectively money is transferred. And then you transfer anything you need to on that day, like any final keys, passwords, etc. There will also be post-completion obligations, so ASIC forms, etc., that need to be submitted to officially confirm the sale. Now that brings us to the end of the presentation. I know it's a lot to digest, and I would love to go into more granular detail on all of this. I could talk for hours, I'm sure, but please do reach out to me afterwards. And please do download our guide to share sales in the resources tab or by scanning the QR code. It is incredibly helpful, and I'm more than happy to answer questions. Now, we do have an upcoming event which you might be interested in, which is a live event at the LegalVision offices, positioning your business for an attractive acquisition with yours truly, myself, and 2 other experts in the space who are fantastic and I've worked with previously. It will be a fantastic, fantastic session. So I hope to see you all there. Now, just before we move to the Q&A, I should just mention the LV membership. So it's effectively you get 100+ specialist lawyers, which I think is very cool, for all of your business as usual needs. Now, it's effectively like having a legal counsel at a fraction of the cost. So our team can assist you with unlimited document drafting and reviewing of business contracts, unlimited legal advice consultations. So if you'd like to speak to me, only if you'd like to 6 times in a week, that's of course fine. And then unlimited domestic trademark registration. So please do reach out to myself or a member of the team in case you would like to explore that. Now I can see some Q&A coming in, which is amazing. I love that. But I would like to just address the first questions that were pre-submitted. So during a business sale, how will employee and supplier contracts be prepared to be effective as of the settlement date? Now that's a really good question. So in an asset sale, contracts are novated, meaning the party to them is effectively changed from the seller to the buyer. Now, it effectively means the buyer is simply stepping into the shoes of the existing contracts, but there's no change to the fundamental terms. And those novations will be dated on and from the date of completion. And that's how it becomes effective that the transfer of ownership has taken place. Now, alternatively, in some cases, the buyer may wish to put in place entirely new employment and supplier contracts if they're not happy with the old ones. It happens all the time. They may simply have just a template that they like to use. In that case, the development of those new contracts would be a condition precedent, as I just mentioned, to the sale, and they would need to be dated and signed in order for completion to be effective. Now, the next question, I would love to hear about suggestions for business coaches who help businesses in this transition, like how to start and then, of course, transition family members and what legalities. So the big 3 things, as we've discussed here, is deciding if it's the right time for you to sell, then determining a realistic purchase price, and then finally, DD cleanup process and identifying the buyers. Those are the biggies. If you take nothing else away from this, take those 3 or 4 fundamental things away. Now, succession planning is a really, really interesting question. Of course, it comes up with a lot of family businesses. And in M&A, it is crucial, of course, for a smooth leadership and ownership transitions. Typically, we see succession planning documents or transitional arrangements that are formally documented. Now, they may include leadership selection, so choosing the right leaders post-sale, a bit like succession, if any of you've seen that, it needs to be bang on. Structuring how the ownership is passed, ensuring tax efficiency, so ownership transfer. Legal and tax considerations, of course, particularly while you're dealing with discretionary family trusts. If you're transferring any of those interests, it's really, really important to get specific tax advice on the trust structure. And then finally, clear communication. So if it's a family business, succession planning is really commensurate on strong comms in that space. So legal requirements of a merger. I love this question. So we call it M&A, but mergers are much, much less common than acquisitions, but there are 4 main requirements. So first, shareholder approval. So the 2 companies looking to merge, of course, the respective shareholders will need to first agree. Of course, they will with an acquisition as well, but it's called dual shareholder approval in a merger. Next, they do mutual DD. So everything we've discussed earlier is reciprocated between 2 people. Now, that involves, pooling resources, of course. So you'd want to make sure the finances of the company that you're merging with are not underwater and they look good to go. Now, a big thing with a merger is regulatory approval. So the Australian Competition and Consumer Commission, or the ACCC, might need to approve the merger, especially if they're of the view it could reduce competition in the market. Now, this is really, it depends on the industry. So if it's a telco, yes. If it's retail, a lot of the time. If you're an MSP business, not so much. But you really need to think about whether the ACCC should assess whether it results in a substantial lessening of competition. And if you're, the sniff test, if you're a little bit worried, then you should ask legal advice. And of course, we provide Foreign Investment Board approval and ACCC advice as well. And then with the merger, the fourth thing, is the formal agreement outlining the terms of the share exchange and some of the more logistical structuring things like, will we merge into a new company? Will we merge into one of the companies, so company A and then dissolve B? And all of the admin and logistics that surround that. So those are the 4 main things that go into a merger. Now I can see some questions here, which is great. So I'm just opening my box. Richard, hello Richard. So great prezzo, isn't share sale the same as capital raising? Does it follow a similar process? I love this question. This is a great question. So it is not the same thing. So a share sale is when existing shares of a company are purchased, whereas capital raising is when new shares are issued under the terms of what we call a subscription agreement. I do a lot of capital raising as well, so please do reach out if you need a hand. And the fundamental difference is with a share sale, if there's 100 shares on issue and 100 shares are then bought, all the existing shares are bought. Whereas capital raising, you might have 100 shares on issue before the capital raise and then 200 shares on issue post the capital raise. So the primary distinction is purchase of existing versus issue of new. Now, a subscription agreement has a lot of the things that I've talked about. So a buyer will want to do DD, or an investor, as we call them in a cap raise. There will still be the same conditions. It follows a very, very similar process. There are, of course, some nuances around. There will be much more of a focus on the existing capital structure and table of the company, particularly if there's debt. That will form a huge part of the DD done by the investor or the buyer. And there will be other things like the investor will want to have a good relationship with the company because they're effectively coming into the company. It's not a total buyout, meaning seller and buyer never speaking ineffectively. So there's a lot of relationship and communication around establishing good comms between the two. But we have a fantastic presentation on cap raising as well, which we can certainly provide following this too. So Ray Kennedy, hello Ray. How do you deal with situations where the buyer is a competitor and balancing between disclosing enough information and not giving away too much regarding the commercial position that could compromise the seller? This is a great question, and I'm dealing with something very, very similar on a current transaction. And of course, it may be a competitor if it's a trade buyer or an institutional buyer. And it's completely fair to be worried about giving your secret sauce away, as I like to call it. But what we typically do is structure the NDA very, very specifically such that the disclosure of information as part of a trade sale is actually tranched over time or drip fed. So as part of the DD phase, there will be a stage DD phase. It might be a 4-phase DD. As part of DD process number 1, you might disclose, broadly what you have in the business, but no secret sauce. And at each stage, as you're confident that it is a bona fide buyer, you disclose a little bit more, a little bit more, a little bit more, a little bit more. And it gives you ultimate comfort that the competitor, of course, won't be running away. And when you get to stage 4 of disclosing the secret sauce, you will almost be guaranteed to already be locked into a sale agreement. So we structure it very, very specifically on that basis. Now, I should also say I have seen 1 or 2 situations, of course, unfortunately it does happen, where an NDA has been breached and a buyer has gone away and, given the market a little bit of information. We also structure our NDAs extremely carefully with break fees or particular penalties if that does happen. So it may be that in the event that you're able to establish there was a quantifiable loss because of the disbursement of that information, you'll be able to claim a certain portion of the purchase price that would have been paid. So I've seen, anywhere from 5 to 10%. And what that's good for is really it disincentivizes anyone to go away and use the secret sauce because it's just not commercially sensible. And ultimately, a buyer will be on the hook for any damages coming out of that. But it's a really good question, Ray. Thank you so much. So I think that actually brings us to the end of the presentation. Bang on time. Thank you so much, everyone, for joining. As I said, my email's available on the website. I'm a great sounding board. Please reach out to me for anything. And I certainly hope to see you all at the in-person event and have a wonderful afternoon. Thanks so much, everyone. Bye.